Dr. Kohli, please stay on with me. I'll come back to you. Now, the benchmark equity index Nifty 50 delivered the highest return among all major indices on the National Stock Exchange over the last year, as per data shown by the NSE report, highlighting market performance data. The report stated that Nifty 50 rose by 10.5% between December 31, 2024 and December 31, 2025. The index closed at 23,645 on December 31, 2024 and climbed to 26,130 by December 31, 2025, registering a gain of 2,485 points during the period. This made Nifty 50 the best performing major equity index on the NSE in the last 1 year. In comparison, other key indices posted relatively lower returns. Dr. Sharad Kohli is back with me. Dr. Kohli, what would you like to say on this?
Well, I think the Indian equities haven't given a bad return last year. I was looking at the numbers. We've given a return of about 12%, which is not all that bad considering massive selling by the FIIs and the FPIs last year. They sold about $19 to $20 billion worth of stocks across the board last year. And this was duly supported by buying from the domestic institutional investors, the mutual funds where retail investors have been participating in a big way through SIPs and direct mutual fund investment in chunks. So I think the Indian equities have done fairly well. The India growth story is intact. The corporate results have not been all that bad if you leave out some of them. Well, most of the corporate industry has given very good results. So that has converted and shown into if probably the FIIs and the FPIs had not sold, we would have been 15-20% higher than where we are today. But despite that, so which shows that we are not all that dependent on FPIs and FIIs as far as holding our market is concerned. It's a very decent return. It may not be a outstanding kind of a return the way gold and silver is done. But then I think the markets have held their fort and have been very steady in giving the returns. And I am hoping the same for this year as well. There might be some volatility. I think the viewers would be more interested in knowing as to how's the market going to go starting today in 2026. I think the markets will be volatile because there's a lot happening geopolitically as far as the world is concerned. And vis-a-vis the economic scenario, I think we can expect again a lot of reforms within India and a lot of uncertainties across the world, whether it's US or other countries. So investors need to be very watchful and be very careful. Buy on dips is the strategy. The holding long term is the magic mantra, Vaishali.
And Dr. Kohli, what do you think? Can this momentum be sustained in the coming year, or should investors expect volatility?
Well, as I said, volatility is definitely going to be there because geopolitically things are not looking very, very great as we enter into 2026. We saw China doing a military drill around Taiwan, America, Venezuela, tensions building in Iran as well. Russia, Ukraine has become more intense as far as the conflict is concerned. So geopolitically speaking, I think things are quite volatile, which is going to impact the market. As far as I said, economic factors are concerned, the global economy is not doing well. A lot of so-called developed countries are already in recession. I can name a few. It's the United Kingdom and France, Italy, and to a large extent, even the US, although they say their GDP is 1.8%, but I have my doubts because the numbers or the parameters say otherwise. So I think it's going to be a very volatile year, which is why I said the investors need to be very careful. They need to be very selective. The choice of stock should be very, very carefully done. A very detailed fundamental analysis is required. People must consult experts while advising. The market is definitely going to be volatile either way, Vaishali.
Thank you, Dr. Kohli, for joining me on the broadcast. And now moving forward.